So here we go. This is cost management systems. We get to learn about activity-based costing, A to the B to the C. Not like ABC gum, it's ABC accounting, totally different, okay? Although about as pleasant. Yeah, it's about as pleasant. Just-in-time and quality management systems. So that's what this kind of has three. Come on, be good to me. Oh, I know why, because the little part that you plug in to make it work is still plugged into here. Yeah, you can slow clap it. Bring it in. All right. So here's their learning objectives. This week, it's a dog. I don't know why. It's a cute little dog. I believe that breed of dog is a, what is that? A Yorkshire Terrier? I don't know. Some sort of terrier. So here's what we're going to do. We're going to assign direct costs and allocate indirect costs using a predetermined overhead rate. You're like, wait a minute. Haven't we been doing that for like 3 chapters? Except this time we're taking it to a new level and we're using multiple allocation bases. What? I know, I'm about to have your mind blown, right? And then in activity-based costing system, it's like multiple cost bases. You'll love it. And then you can read the rest. We'll just go through it. That's a cute little puppy. All right. So the first thing they want us to cover is assign direct costs, allocate indirect costs using predetermined overhead allocation rates. So this is stuff we've already done. So the concept won't be new, okay? We already know that we have direct costs, direct materials, and direct labor, and then we have overhead. That's not new. Do you notice how I moved this? Do you have a cleaner shot? You're welcome. All right. She's like, okay. Remember the difference between direct materials and direct costs. Those are the ones that are easily traced to specific products. And then we have the allocated costs, right? This is what we've been doing all class to this point. So pretty much this whole chapter deals with just this part, manufacturing overhead. The reason is because what's happening with overhead is you have all these costs that are hard to trace to a specific thing, right? That's why it's overhead as opposed to a direct cost. Direct costs, we don't need multiple ways to deal with because there's really only one way. We know the cost goes into the product. We put the cost to the product. It goes into the inventory cost and then becomes cost of goods sold when we sell it. But overhead, what happens is business owners want more and more to be able to refine down the actual true cost of a product. And so what you find is the way we've been doing it, we use a single predetermined overhead rate that's based on one cost basis, like direct labor hours or something like that. It's not always super accurate, right? I mean, it's this rough estimate, and it works. But if we want to start trying to get drilled down and say, what does this product cost me, 1 unit of this product to make? We might want to come up with multiple cost bases or something else, okay? So that's the idea here. So this is what we've already been doing, single plant-wide rate. It's kind of the traditional way of doing things. I'll tell you, this concept arose like back in like the turn of the century, and really got big in like the 1940s, like just pre-World War II and post-World War II, where the United States was in this huge kind of production boom. They were just making stuff. You didn't have to worry about if you were going to be able to sell it. You just had to like crank it out. And so when you're making thousands and thousands of identical units, it's not a big deal to use a single plant-wide overhead rate and just apply that to each unit. So that's how that started. So we know that what we do is we take the total estimated overhead cost and divide it by the total estimated quantity of the allocation base, whatever that allocation base is. So I think their example is they have a company that has $100,000 overhead estimated costs and $250,000 in estimated direct labor costs. They divide it and they say, hey, we're going to allocate that overhead at 40% of direct labor costs. So for each product then we'll charge the direct labor, the direct materials, and then we'll take the direct labor, multiply it by 0.4, and that's the amount of overhead we'll apply to that, right? That's what we've already done. So here's their like, what if? What if there are two departments with different allocation bases? Like sometimes using direct labor as an example works really well for one department in your business, but it doesn't. Maybe you have a department that's not very labor intensive, but it's quite intensive in other ways. So you might want to find some other cost basis for allocating overhead in that case, okay? So we can do multiple allocation bases. So here we go. In their production department, let me see. So they give us this example. Well, they don't tell us all the details of the example. So this is the total estimated overhead cost for the production department are $80,000, and the total machine hours are 20,000. So maybe you have a business where you say, hey, in the production department, direct labor hours isn't really the best way for us to allocate our overhead. Instead, let's use total machine hours. So you do the same thing. You take the total estimated overhead costs divided by the total estimated quantity overhead allocation base, and that gives you some rate, right? That's no different than what we've done before, except that we're going to apply overhead in this department using this basis, machine hours. And then when it goes to the software department, where there's no machining at all, they decided that direct labor costs is the way they want to allocate in that department. So they take the total $20,000 estimated overhead cost divided by the total direct labor cost, and they find some percentage. So what that lets you do is more fine-tune how you're applying overhead. Okay? That's all it is. And as you can imagine, in some settings, that might work better. The hard thing, though, is now when you said, because if you think about it, they said 80,000 is in production and 20,000 overhead in software. Somebody had to make that decision, right? So in the first time they did it, they just had to estimate $100,000 total overhead for the year. What do they base that on? Probably historical situations, like, well, how much in the past have we done? How much has been our overhead in the average year? Now you have to have somebody say, okay, well, what percentage of that? In this case, it was 80-20, right? 80% of that $100,000 is in the production, and 20% is in the software. And again, in a book problem, they just have to tell you that. They have to say, of the $100,000, 80% of it will be applied, of the overhead will be applied during the production process, and 20% in the software department. In real life, what you have to do, honestly, is like if you're the managerial accountant, you have to kind of get to know all of the managers and work with the managers and say, tell me your processes and tell me how costs kind of go through. Because what you find is that managers of departments, they understand a lot about the process, but they don't always understand a lot about the costs involved with those processes. So they can kind of walk you through what happens in their department. A good managerial accountant, where's he at? This guy, Blaine Greer, we have on one of our little purple signs about our monsters going places. He works at FMI as a cost management accountant. So he works with a specific department, and he goes and, what's that? He accounts. He tries to work with the managers to understand their processes, and then he tries to come up with ways for them to manage costs more efficiently. Can you imagine if you do that incorrectly, that you could have a bunch of managers pissed off at you, right? If you're like, oh, you know, you don't need all these employees. Just cut 3 guys out of your shift and you'll save this much money. Well, that's not going to always make you the most popular guy around. So he needs to work together with the managers and get their idea of how to manage costs. And that's what he does. All right. So now they have their total cost. So their direct manufacturing overhead on production, manufacturing overhead on software, total manufacturing overhead. Then they can divide that by the number of units, and it gives them a manufacturing overhead per unit. Direct materials, direct labor, and the manufacturing overhead per unit. And now they can come up with a pretty solid number for this company happens to have 2 models, a standard model and a premium model. So this is not that different than what we've already done, except instead of a single allocation base, we've now made a separate allocation base for each department. That's all. Yes, Michaela. No, each model is a model of the product. So that's why you'll see the rate, like but you'll see like the premium model costs more per unit. And if you notice, it's because, you know, it looks like there is, you know, there's more directly, yeah, there's fewer units, 500 to 2,000, but if on a per unit basis, they're actually spending more on direct labor hours and stuff like that. Again, what's hard about this to me is that it's this whole canned scenario in a book. In real life, you would be working with people, you'd know exactly what the products were. Instead of having this sort of intangible, like, wait, what is the product? You would know, hey, if I go there, they make these two products, the standard model and the premium model. And then it would be like almost common sense that, of course, the premium model has more stuff into it. That's why it's premium. But when you're looking at it in a book, it's like confusing as to what that means sometimes. It is for me, at least. All right. So now they just want to kind of show you the difference. If you use the single plant-wide allocation rate, here's the costs you came up with, $273.20 for the standard model and $407.20 for the premium model. And then if you use the multiple department allocation rate, it's $275 and $399.84. So what you're finding is there's this little difference between using the two methods. And the multiple department allocation rate is more fine-tuned. That's probably closer to the actual cost of making each unit than the single rate, okay? Again, though, it comes down to kind of meeting with the managers and saying, and understanding their process. Because that allocation base, whether it's direct labor hours or machine hours or whatever it is, should really be the thing that drives the consumption of overhead, right? And so if overhead includes management salaries and it includes the cost of renting the factory and all those things, you'd have to say, well, what part of your process should be responsible for us, making it the allocation base? And it's not an easy thing to do. The managers often know better than the accountant does. All right. So really that was a lot of talk to say the only difference here is instead of a single allocation base, which we've already done, we have multiple allocation bases. Okay, that's it. So activity-based costing. It's just, okay, so let me preface it by saying all it is another way to try to break down the predetermined overhead rate. Another way to try to be more accurate in allocating the overhead to each job or each product. Okay, other than that, it's not really any different. So you can read that, focuses on primary activities the business perform, uses cost information to make decisions that lead to greater profits. Process determining the cost of activities as building blocks for allocating indirect costs to products and services. What that really means is instead of a single allocation base or instead of two allocation bases, we might have 5 or 6 or 10. Okay? Sounds like a lot, but if you think about it, once you set it up, using a computerized system, it's not that hard. You just allocate on the basis of different things depending on the activities of the business. So let's give an example. All right. So what they're saying is, hey, look, we have all of these activities involved in the creation and delivery of our product. We have a quality inspection, we have warranty services, we have shipping, we have setup of the machines, we have machining, we have purchasing. And what you're doing is you're recognizing that all of those activities consume overhead assets, okay? A lot of times you don't think of it that way. You don't think that purchasing, you just sort of buy stuff, but you probably have a full-time, in a big company, you've got a full-time staff of people who are in the purchasing department, okay? And so the more stuff we purchase, the more our costs, our overhead costs we're going to consume because we have to use the time and efforts of those people, etc. So here are the steps of an activity-based costing system, A, B, C. Step 1, identify activities and estimate their total costs. In a book problem, that's usually going to be laid out for you. Okay? In real life, again, it's a matter of walking through the process of producing and selling the product and saying which of these are production costs and which are sales costs and separating off sales costs because they'll be period costs. And then saying of the production costs, what are the processes and how do they consume overhead? Step 2, identify the allocation base for each activity and estimate the total quantity of each allocation base. Again, best done usually by the department managers who work with it all the time. Really almost best done by the line manager. A lot of times there's a department in a production facility, there's a department manager who oversees all of the production in that area. And then there's, say 3 shifts of people who come in and work on the production line actually making the product. And there's usually a manager on each of those shifts. They're a line manager. And they're usually the ones who know what the heck's going on, right? Because they're with the product all day and they know how much it really costs and things like that. Step 3, compute the predetermined overhead allocation rate for each activity. Step 4, allocate indirect costs to the cost object. That sounded confusing. Let's go through an example. All right, so there's some examples of activities. Those are the things you identify. Again, in a problem, they're kind of given to you, so you won't have to do that step. All right, so here's our traditional system like we've already learned. We have manufacturing overhead, we have direct labor costs, and then those flow directly into the product. In an ABC system, we have our manufacturing overhead broken down by activity, and then we have a separate allocation base for each activity, and then each of those allocations flows into the different products. That's confusing. All it really means is that you have, instead of one allocation base or two, you have, in this case, 3. Okay? You're splitting up the overhead in other ways. So what you have to do is say, well, how much of the overhead is part of setup, how much is part of production, how much is part of testing? So someone's got to make that estimation. And then you have to say, well, what are the allocation bases? For setup, they decide it's the number of batches, because each time they run a batch, they have to set up the machinery differently. For production, it's the direct labor hours, because it's the number of people working and how many hours they're working. And then for testing, it's the number of tests they run. So then if you know that a certain amount of the overhead is going to setup, if you divide it by the number of batches, you know how much overhead per batch you have, right? And then you can apply it. That's the idea. All right, so step 2 is identify the allocation base for each activity. I already went through that. Setup, number of batches, direct labor hours for production, number of tests for testing. They know how many hours and batches and tests there are for each model. So step 3 will be to compute the predetermined overhead rate for each activity. So for setup, it would be the $15,000 total estimated overhead cost divided by 60 batches, or $250 in overhead applied per batch created. Production would be $65,000 total estimated overhead cost. Again, this will be given to you in the problems, divided by 12,500 direct labor hours, so $5.20 overhead applied per direct labor hour. And then for testing, $20,000 total estimated overhead divided by 10,000 tests, or $2 per test. So now they've further kind of drilled down and become more accurate in how they're going to apply overhead. Okay? Step 4, allocate. Well, that's easy, because if you know that if you have a rate and then you have the actual quantity, you just multiply the rate times the quantity. So here in the standard, they do setup. $250 per batch times 40 batches is $10,000. Production $520 per direct labor hour times 10,000 direct labor hours. And then you can add it all up, and that's the amount of manufacturing overhead, $77,500, that they're going to apply to their standard product. Divide that by the number of units, you can get a manufacturing overhead cost per unit. Do the same with premium. I hope you're starting to kind of recognize as I go through this that more and more Excel is going to become your friend for problems like these, because it's columnar. Or, in other words, things are in columns where you have to multiply out the columns and then get a total. And so the more comfortable you are using something like Excel, the easier this sort of work is. And when we get into master budgets and stuff, it's going to be even more so. So that's part of the reason I'm trying to force you to doing an Excel thing each chapter, every other chapter. It's because it will help you, Michaela. Yes. Yes. So this chapter will have an Excel assignment as well as your regular homework assignment. I see the joyous look on your faces. What? Yeah, I think you will excel. All right. You always excel, don't you? Well, you can't be perfect. All right. So now they're just kind of comparing them. Here's the cost per unit at a single plant-wide rate, cost per unit with multiple department allocation rates, and then cost per unit with the activity-based allocation rate. And you see, again, there's some slight difference between the two. In fact, it's a pretty significant difference on the premium model. And so why it matters is if you are basing your pricing, what you're selling to the customers, on your cost, and you don't have a good accurate estimate of what your cost is, you can kind of see the problem inherent in that right off the bat. There's kind of two ways to set pricing. One is to say, I know what my cost is and I want to make a certain amount of markup and to go from there. The other is to do what's called target pricing, where you kind of go and you say, this is the sales price I think I'm going to sell it at. And so I've got to see how much I have left in there. You would think that that sounds dumb to just say, I want to sell this for $400 a piece or whatever. But I'll tell you, it's what most people do. When I work through a business planning scenario with people, and they'll say, well, I'll say, what are you going to sell your product for? How much? And they'll say, they'll always give you like this hard number. And you're like, where's that number coming from? And it's either, well, I saw some at the store and that's what they were running for. You realize that the store bought that from a producer and then marked it up. So you probably can't sell it for that because the store is probably not willing to pay what they're selling it for, Or they just have this feeling in their heart, like this is just what I think it should cost. And you're like, well, where does that come from? What does that even mean? So it's really smarter to say, I have a really good accurate estimate of what this costs. And now I know what the product cost is. I still have to cover all of my selling and administrative expenses and make a profit to kind of work from that direction, work from the cost of the product. And then compare what your sales price will be to what the market's doing, right? If you're going into a market with lots of competitors, you still have to say, well, here's how much I can't really sell it for less than this, but the competitors are selling it for this much. And if you're way above what the competitor's doing, then you've got to rethink the whole thing. Can I sell this as a premium product? Can I convince people that they need to buy, they're willing to pay extra for this because it's, a Mercedes or whatever you're selling? And if you're way, way below, you've got to ask yourself a lot of times, what am I missing here? Is the market just really fat and so people are just getting this huge markup, or is there something else I'm missing? And it just depends on the product. What's a Lexus? A premium Toyota? You put $2,500 of leather and extra molding in it and sell it for $20,000 more? Sure. People do it all the time, right? Really, is a Lexus really $20,000 better than a Toyota? It's probably cost-wise $5,000 more expensive to produce or something. And that's what we always want to do, right? We want to somehow premiumize our product, get people to think this thing's worth paying a premium for. Chicken wings, you know what they used to do with chicken wings? They would grind them up for feed because they were waste. No one would pay anything for them. They're all bony. And now, do you know what the most expensive part of the chicken is? It's chicken wings, because they made a market for it, right? And people said, and now it's like the most desirable part per pound. That sounded weird. Yeah, you're the most desirable part per pound. Don't try that as a pickup line. It doesn't work. All right. See, you always got to take it to the next level. All right. Well, but I'm pretty sure I could say anything, and you'd piggyback. Yeah. All right. Use activity-based management to make decisions. All right. All right. So activity-based management uses activity-based costs to make decisions that increase profits. Hello, that's the whole point of managerial accounting, okay, is to make decisions to increase profits. ABM decisions include pricing and product mix and cost management. So that's kind of what I was just saying. These are the sorts of decisions you have to make. Product mix is a big deal in business success or failure. Most common issue I find with product mix is people usually start a business. I think I mentioned this to you guys before, making some product that they really love, something they have this deep interest in, especially artisan type businesses. And then they find out that the world has very few people willing to pay tons of money for really truly custom type of art. And so they usually branch off into something that's more semi-custom or more, or even just mass produced, and they start making their money doing that, but in their heart they still love the art of it, whatever that is. I've seen it with, like I said, I had a custom knife maker. I've seen it, I'm married to an artist, but what you find is because there's so few people, you can spend a lot of time and effort trying to sell the big piece, or you can kind of crank out the mass-produced pieces. And so in the end, they find out like they're losing money almost. It's like they're doing the mass production to support their habit of doing the art. I find that over and over in almost every type of business, even like in ranching. There are parts of ranching and farming that are pretty profitable, but most ranchers love to be out on the range with the cattle, and there's just almost no money in cattle. Not none, but it's a tough business. And so some people would tell them you should need to get rid of that part of it. But if they get rid of that part of it, they feel like they might as well just be going and working for someone else. And so what you're trying to do is help them as a manager, as the business grows, to find an appropriate product mix. How much of your time and effort do you put into the part that you love, and how much of it do you put into the part that allows you to continue to do the part that you love? Yeah, you grew up in a farming and ranching family. Is there more money in cotton or cattle?
A lot more money in cotton.
Yeah, but it sucks, right? Maybe not to you. Do you love driving that picker? Mm-hmm. All right. There's worse jobs than driving the picker, right? All right. I think what it is, it's like farming is a job, but like farming and ranching is like the lifestyle. There's like two things going on there, and you got to endure the one so that you can have the other. All right. So again, the whole point of doing all this activity-based costing is so that we can have more accurate pricing estimates. That's really all. That's what all these slides are meant to tell you. I mentioned target-based pricing versus cost-based pricing. Those are just terms. I wouldn't worry too much about them. If they come up on something, you can look them up. All right. So activity-based management. So we've talked about activity-based costing in a production or manufacturing company. Well, you can kind of use similar models or mindsets in a service-based company. It's the same idea. Identify activities and estimate their total costs. Identify allocation basis for each activity. Compare the predetermined overhead allocation rate, and then allocate the indirect costs to the cost object. So same concept. Not really any different, okay? And then this last concept I want to talk about is what's called just-in-time management systems. For some reason, these books like to still pretend that just-in-time is like a new concept. It was a new concept like when I was first getting into business school, so you're talking 20 years ago. I don't know why they still talk about it like it's something new, although it's still being used to a great extent. The idea is, think about the amount of inventory that sits on the shelf at a Walmart store or at any sort of large business. If you have money tied up in inventory, that's money you can't be using for other things, okay? Like paying employees or like paying yourself or the stockholders a dividend. It's all tied up in inventory. The idea is, in fact, I wrote part of my doctoral work on just-in-time management in small businesses because it's become pretty ubiquitous in large production organizations. And I actually did a case study on the tortilla company here in town. And their production process was in essence to order raw materials for flour tortillas. That's like flour, some sort of leavening agent, right? And lard. And and they have those all like in a storeroom. Then at the beginning of the day, what they do is at the beginning of the shift, they say, here's our production goal for this shift. We need to make this many packages. And so someone pours the stuff into a big mixer and mixes it up. And then somebody like forms that into, I think they do it by weight or something, like balls of dough. And then they have like this, I don't know if anybody's ever been in there, they have like this production line with like rollers, and they kind of hand flatten them and then send them down, and they get rolled, like machine rolled to the right consistency and size, thickness and everything. Then they go from there into like a cooking type of hot plate, which is partially automated and partially there's a person there to like, help the process along. Then they go on to like a cooling rack, and then when they're cooled sufficiently, they get like counted and stacked into like dozens and bagged, and then the bags get sealed, and then they get put into cases, so many dozen per case. So that's their process. And so the idea is, if they've got a huge storeroom full of raw materials, and then they get boxed and they get put in a warehouse. And in that warehouse, then the truck comes in the morning and they have a list of deliveries to take to their buyers, and they load as many on there as they can and they take them. Sometimes they make too many and they have shrinkage, it's called. They have waste. They just get thrown away. You know, they have to sit there too long. Sometimes they mix up too much dough. Sometimes you have the risk of getting weevils or something in your flour if the flour is sitting there too long, right? So you have all these risks of waste. And so we looked at a process where they could go take an order, or their customers could even put in an electronic order for the amount they wanted. One day, that evening they could take those numbers, send them electronically to their suppliers. First thing in the morning, the supplier shows up. Instead of hauling it into a storage room, they bring it straight to the production floor where it's put into the mixer, it's mixed. The whole same process goes with cooking. And instead of the finished product going on into a warehouse, the finished product goes straight back into a delivery truck and it's out for delivery. So you cut out the cost of storage on both ends. You cut out the cost of shrinkage and loss. The downside is you have the potential for that somewhere to go haywire, right? And you end up being late delivering a product, or something breaks down in the middle of it, and you have frustrated customers. So in a just-in-time process, you're trying to balance that and have as little storage as you possibly can, because storage costs money, and as little movement of product. You often don't realize how much cost goes in from moving raw materials from the delivery truck to the storehouse, then from the storehouse to the production floor, then from the production, and then the finished goods to the storehouse, and then the storehouse to the truck. And if you can cut out some of that, you're saving money. Okay, especially in a business like that where the margins are thin. The tortillas are thin, and the margins are thin. So they're going to tell you all this stuff that I just told you with a story that will probably help you remember it better because, well, I'm just a really good teacher. And you're supposed to be like, he was making a joke. He's not really that conceited, but okay. But you're not laughing. So you're like, yeah, he really is an arrogant jerk. And I'm okay with that. So this kind of tells you how it all works. Again, more of the same stuff. They have this whole thing about how to record transactions in just-in-time. You won't be surprised. Raw materials. The raw materials inventory goes up. Accounts payable goes up. Then we put the labor in, so we have conversion costs. And then wages payable. Finished goods inventory. I mean, it's nothing different, okay? It moves from one place to the next. The only thing that is different is they use this conversion cost account. All right, and again, it's sort of like an overhead. It's based on an estimate, and then at the end you have to do an adjustment. But it's nothing new. I don't know why they have a whole separate section when it's really the same concepts. And then the last, I said the last on 5, sorry, there's 6. Describe quality management systems and use the 4 types of quality costs to make decisions. Again, I wouldn't worry about this too much. This chapter and the work in the chapter focuses primarily on the activity-based costing, making the whole allocating of the cost to the different things. The rest of the stuff is like stuff that's good to know, but it's not going to be a huge part of the chapter. Okay. Again, like these things are obvious. The goal of quality management systems is to improve performance, increase customers. Yeah, well, of course, that's what we're trying to do. So here's their 4 types of costs. They break things down to in a quality management system: prevention costs, appraisal costs, internal failure costs, and external failure costs. Again, consider this terminology stuff. I don't worry too much about it. Okay. The worst you would face is some sort of multiple choice question asking you like, what are the 4 things or something? So like know them, but that's as much as you need to know. There's some examples of the 4 types of quality costs. And that's it. So, like I said, I know I kind of covered a bunch of things, but really the thing I want you concerned with is the activity-based costing. That's the most important takeaway. And then be familiar with the terminology of some of the others. Like, you know, you don't have to be able to do some crazy stuff with just-in-time, but you have to understand the concept, which is the movement of the products with as little downtime and with as little inventory as possible. That's the idea, and that's what you really need to know about just-in-time. If you go into some sort of quality management degree at the university, you're going to study all of these there's a number of different total quality systems like that they've developed, and you'll get more of it than you ever want to. But for this is enough. Okay? Any questions? Have a great day.